The Nasdaq down the most as investors digest comments from Meta and prepare to hear from Amazon tonight. Our next guest has a year-end price target on the S&P, which is currently at 41.59. His year-end price target in just about 2 months' time, 4,900, highest on the street. To continue our contrarian week, John Stoltzfus joins us now. He's chief investment strategist at Oppenheimer Asset Management. John, welcome. Did you mean to find yourself in this position?
Kelly, when we raised our target from 4,400 back in at the beginning of August, at that point it meant 4,900 was about 6 to 7% upside to the end of the year, and right now I think it's something closer to 17 or 18% to the end of the year. That said, it's not atypical for markets that are in the process of getting near the end of a Fed funds hike cycle to have a lot of arguments happening between bulls and bears. Our target when we put in the 4,400 target, when we put that in last December, people thought we were nuts because the S&P 500 had a horrible year in 2022. A lot of people were expecting that it would extend into 2023. And indeed, there was several fabulous rallies during this year that have occurred. And now at this point, we are experiencing a correction that is significant enough to catch even a distinctly bullish view's attention. That said, you've got to remember that when we put that raise that target, we were expecting that the Fed would continue to be vigilant against inflation, but would remain sensitive to the effects of its policy on the economy. And it has remained so that we have, and we also expected, we said it will depend upon the resilience of the economy. Today's GDP print says resilience all over it. And the current third quarter earnings cycle, the third quarter earnings season is showing resilience. You've only got, I think, 2 sectors right now with about 40% of the sectors having reported negative earnings.
So, John, why is the market not responding to all of those things? You ticked off the boxes and they were all check, check, check. Yeah. But the market's down from where it was when you made that switch.
I would say I think the real significance, dollar, would be when we look at the 10-year yield. Once it breaches 5%, if you consider the generation gap that exists in the markets, 5% sounds like an extraordinary rate of interest or a yield on a 10-year Treasury. But from a historical perspective, 4 to 5% is really what a 10-year yield usually would be like during normal periods. The problem is for 15 years, we have been predominantly in emergency periods, whether it was the financial crisis of '08, or it was the pandemic, or the process of the worries about would the pandemic resurgence return, would the whole supply chain be resolved, what would happen. And I think the highly leveraged players also are deeply incensed about Fed policy, raising the benchmark from a range of 0 to 0.25 to 5.25 to 5.5. And this is the protest. You're seeing a tantrum right now in our viewpoint.
So you're arguing that what didn't cooperate here was longer-term bond yields, and that's what spooked the market.
That's exactly. And ironically, it's the long-term bond yields coming up that will actually help the Fed be more sensitive going forward in the next 12 months or so, as inflation is brought down by just a slowing in the economy, which is not uncommon when the Fed is tightening. And,
So let me ask you a little bit of an inside question about your business, because I don't know. You made that $4,900 price projection on August 1. Are you able now to change it if you wanted to and say, oops?
We could change it. and I've got it from a point of being reasonable. And needless to say, it's under consideration. Should we? I mean,
Yeah.
the problem is we're running out of calendar time. So should we do as the Bears do, where, the Bears have been predicting a recession now for several years, and they just keep pushing it forward. So we might have to push this target forward. But what we see is the wonderful thing is, once again, bond issuers have to pay for the privilege of borrowing money, and bond buyers actually get something in return with a coupon.
Yeah.
It threatens zombie companies, memes, all kinds of gambling type thematics, maybe the cryptocurrencies. But for fundamental investors and for retirees, this is a good thing.
John, thank you very much. We appreciate your candor today. John Stoltzfus of Oppenheimer Asset Management. We'll see you again.